My guest today is Neil Tva, an investor and operator who spent the last 17 plus years building and scaling e-commerce brands. He did it long before it was cool. He launched and exited 8-figure physical product businesses and even raised 100 million to build an Amazon aggregator, only to walk away when numbers stopped making sense. Today, Neil is a partner at Patriot Growth Capital, where he combines patient capital, operational playbooks, and the mission to support veteran-owned businesses through strategic acquisitions in the 5 to 50 million range. Thanks a lot for coming to the podcast, Neil.
Thanks for having me on today. I appreciate it.
You've spent almost 2 decades building, scaling, investing in physical product brands. I want to start with a bit different question. What's something about this journey that changed you the most?
Patience. Patience and perseverance are the first 2 things that come to mind. When I was raising the capital and going forward, it wasn't my first time doing that in business, but it was of obviously specific nature going to the physical products side. So as you just go through that process, and having a relationship-driven aspect of building the trust and the know and the like relationships that it's required to get people to invest in you or invest in your businesses or understand what you're doing, it takes quite a bit of time to become an operationally proficient individual and my partner and spending years doing this ourselves. So with, more than 12 years experience in the physical product world and generating, tens of millions of dollars in this, we finally, felt like we had enough experience to really tackle the market. And that's when we went after it. It's just the market didn't meet expectations when we pulled it all together finally.
If we go all back, where did it all start? Because there are so many different opportunities to pursue. Why this exactly?
Yeah, well, I got into the physical products world because I was trying to solve a problem in business. And business is nothing but a series of solving problems, literally. You either solve the ones in your businesses or you solve it in somebody else's businesses. And that really creates opportunities for you. And as I was trying to solve a problem in my business, which was I was running affiliate offers, I was doing lead gen marketing and mobile marketing for lead gen offers. I did not own the offer at the end. So what ended up happening is if I'd get something going really well, then the offer owner would want to change it or end it and kind of mess up all my marketing. So what it came down to is I was getting really good at doing that. But I was getting really tired of kind of being on the hamster wheel. In some ways, I was still trading time for money. I hadn't created any automation. I hadn't, created any force multipliers of my efforts. And so I said, what is the, easiest way to start doing that with my knowledge and skill set? And someone said, hey, have you ever thought about physical products, building private label brands and owning the whole product brand? And I said, no, actually I hadn't, but I went on the journey of figuring that out.
So how do you define great business in the physical product space today? And what I want to understand here is today, after doing it for such a long time, do you prefer to start brands, test ideas, find product market fit, or you prefer to buy a business and then grow and scale?
Well, there are opportunity costs. If you do a traditional SWOT analysis of strength, weaknesses, or opportunities and threat on either one of those opportunities, there are pros and cons to either of them. There's the build it all and keep it small so I own 100% of it and then work to build it into something greater, or there's to acquire greatness from a company as brand and then take that brand and try to leverage it into new sales channels and new methods of marketing or opportunities to expand or grow it. Both of those are different challenges. I love the startup challenge, aspect of it. I've always, a little bit of ADHD, maybe a little bit of self-deprecating pain, but there's always that opportunity and fun to carve out a market where you see an opportunity with a product and you see a brand segment and you see your ability to come in and maybe slip into the number 2 position. And boy, it just gets fun to go in there and do that hunting, killing and go in there and really attack and go in and do what is really good and see that product start to raise up, see that brand mature. We build everything with the end in mind. Everything is built to an exit. So we start with the entire aspect of building the business steps and fundamentals, the automations, the manufacturing. Everything is built to be able to sell it, right? So as we grow forward, I know that, eventually someone's going to want to acquire this. And as somebody who is in the acquisitions space, for physical product brands, I know exactly what to look for. So I'm always looking to, grow these brands into a state of saleable assets. And we are building an asset. That's really one of the biggest things I love about the component of building first and growing is you're building an asset. Now, there's the opportunity cost of buying someone else's asset. Now, not knowing it, not growing it, it might be a $10 million or $20 million business, but it comes with its own unique set of problems. It comes with its own threats. And with that, the question then becomes, where are the skeletons in the closet? Where are the things we missed? Where are the sideways opportunities that we can't see? We're blindsided a little bit by this moment because we can't see what the the person who's continued to, operated it continually, daily, weekly, monthly sees. So we have to do our best to try to step into that position and just ask as many questions as we can. And then we got to go through the normal due diligence process and the letter of intent, and we have to try to drive out any of those gotchas that we are trying to miss as we get into the process of growing and building. What you don't want to do is buy a company that, maybe doesn't have all the upside potential you thought it had. A $10 million company may not have a $20 million market. A 20 million may not have a 50, but it just really gets to how you can structure and change and open sales channels and even address marketing concerns or financial concerns at the operations level to potentially give that business its opportunity to grow, to expand. And as people are investing capital, of course, they always want those returns. And so you always have to weigh that in mind as that business is growing and going. So we look for certain standard points that we like to see in these companies to see what we could, our buy box, if you will. And we just want to see that upside potential be something that we can impact it relatively quickly, that perhaps by just network connections, experience, tactical aspects of that, we can impact that business positively in the next 3, 5, 7 years before we exit it again. And those are just different mindsets. There's two different things going on here. People think it's easier to buy a company, but sometimes it's easier to start one.
Hi, friends. Today's episode is brought to you by ScalePath, peer groups for holdco and small business owners. If you own a business, you're probably making mistakes left and right, mistakes that cost you time and money. ScalePath has built a community of other business owners who have already made those mistakes and will share their experiences to help you avoid them. Each group is small, just 7 operators with similar business models and revenue. You meet once a month on Zoom to get direct feedback on your biggest challenges and often hear about opportunities in other industries that might apply to your own. There are groups for home services, B2B, manufacturing, professional services, holdco owners, and many more. Plus a community forum, expert calls, a members-only podcast, and some big discounts for various events. Apply to join ScalePath at joinscalepath.com and schedule a call with the founder Rand Larson, or just check the link in the show notes. Again, join scalepath.com and feel free to schedule a call with the founder Rand Larson. Now, back to the show. So when it comes to those skills and experiences, I'm sure they came with your first projects and first businesses which you started and eventually sold. Could you give us an overview of what type of businesses they were, maybe what type of products, and the idea that everything is to sell? Has it always been like this, or it?
No, I actually adopted that process about 6 years ago. I actually went back a little farther. 2016, I met a gentleman named Kevin Harrington, and he's the As Seen on TV founder. He was original Shark Tank founder or whatever. And as I got to know him better through relationships and kind of expand my brain into the bigger, business of acquisitions, growth capital, multi-channel sales, and big business, right, into the billions. It really kind of started to reshift my abundance thinking. It really started to get me thinking very differently. Not that I wasn't thinking small scale, I just wasn't thinking, and I couldn't quite see the forest through the trees. And in that conversation and time together, I started to see things a little differently. And as I saw them a little differently, that's when I saw the opportunity to go out and run for acquisitions. And get that capital raise that we needed to go out. The market just changed faster than we were able to finalize our capital raise. It had extended the credit lines of many of those companies. They were taking on too many operations they couldn't sustain. There was a clear bubble that was building. That the question was, when was it going to burst? There was, $20-something billion dumped into those acquisitions. There was a lot of mismanagement. There's even questions now that some of the larger companies were not doing, fiscal responsibility to their shareholders and to the investment. So now they're under investigation. But in that process, we just saw businesses being valued 30-40% higher than the market standard. And we didn't want to acquire with that potential of a bubble, coming on the other side of it, because you would lose 30-40% the next year. And all of a sudden the investors are like, what did you do wrong? And I didn't want to be put in that position. And as it turns out, that was right. As we pulled back and stopped that process, we saw that bubble burst. And within 2 years after that, companies that had bought, at 50 million were now worth 10. So there was a lot of trouble with that additional market. And that's, we had the foresight. As they say, the narrative comes out of the numbers. And as you read into the numbers and projected the pro forma, we just realized that there was an unsustainable acquisition process And so we pulled out of it. And it turns out that was the right move. And there was a different purpose and value for doing that in terms of the way we were structuring it. And when we pulled out for a few years, that's when I actually met the guys from Patriot Growth Capital. When a different mission and purpose came into focus, it actually made more sense to go back to it. But yeah, the process by which we did that, the realization that we should shift our business model from just build and hold to build and exit came through that process. It was that realization that with our skill set, with the market opportunities, with our ability to operate and capitalize these businesses and the physical products very strong, and to do it in any segment of business. You ask which type of businesses. At the end of the day, I'll put anything in a box and sell it profitably to anybody. I want them to be super happy with it. We have sort of segmented ourselves more into the home and kitchen and outdoor niche, as it turns out, over time. We've made quite a few brands in that space, from kitchen appliances to cookware to all kinds of things around the home. Even, cat carriers and air mattresses and all kinds of stuff. At the end of the day, it really gets down to, can I provide the profitability and value of that business to the consumer who really wants to buy my product, love my product, tell everybody about my brand, and go do it again and again. And when it gets down to the numbers, that's what I actually become passionate about. When it gets down to the business building, that's what I'm passionate about. The products, the customer's passionate about. And I want to be passionate about building great products that they love and want to leave positive reviews for.
Hi friends, quick break from the episode to tell you about our very first and newest sponsor, Spacebar Studios. If you're running a portfolio company or operating inside a PE-backed business, you know how hard it is to build pipeline, shorten sales cycles, and increase win rates without adding a bunch of headcount. That's where Spacebar Studios comes in. They partner with B2B companies doing 1 to 50 million in revenue, acting as a flexible growth team that handles outbound, messaging, and paid media. Their work leads to high ROI campaigns that actually move the needle. They've worked with SaaS, compliance, and enterprise service companies, both VC and PE-backed, accelerate revenue and generate serious demand. So if you're ready to scale smarter, not harder, head over to spacebarstudios.co and check them out. That's spacebarstudios.co and check them out. Now, back to the show. Could you please give me like a timeline of how has it been for you? I'm just trying to understand, when did you meet Kevin and how was the early days? Because oftentimes we do something, we think we know we want to do this, but then you said you had this meeting which really opened your eyes. I want to talk about this as well, but really to give us a timeline, how has it been?
The original split into affiliate marketing that moved into the physical product world, as part of that process, I discovered Amazon and its logistics and system called FBA, Fulfilled by Amazon. And as a marketer who was affiliating products, the last thing I wanted to do was start filling my house full of physical products and shipping them every day. It sounded like a nightmare, right? Because I was dealing in the digital world. So it's very different to move to a tangible product from a digital asset. I can move thousands of units of a digital product and not have them stored in my garage. So what it got down to was when the FBA system became apparent that you could use it to move your product and not touch it, I'm like, okay, that's something I can get into. That was around 2012. Through 2012 to 2016, we built multiple brands. A couple of them hit 7 figures. We had an event, and that's when I met Kevin in 2016. Got to know him a little bit better. From the years of 2016 to 2019, we had developed conversations, relationships, and network that eventually led to, hey, let's talk about together getting into the aggregator space, formed a company called Voltage Portfolios, and then went out from 2019 to 2021 and raised about 50 million through 2 home offices. And that 50 was going to turn into 100. Through the acquisitions. We were down to paper, we were down to the legal, we were down to the deal points in 2021 of November. I pulled it. It just no longer made sense fiscally for us to go there. So that's the time frame. In the background, we were raising up our own brands. We were working with additional companies. We were taking on new operators and training them over 12 months to build up their own brand. So I was raising up an army of brand owners and builders behind me at the same time. As my partner and I were training them, because we were using them we were mutually working with them. Using them sounds the wrong way. I don't have employees, so I decided that when I got rid of employees a long time ago, I didn't want any more. So when we spent the time thinking about how to build the operations, we wanted to overcome operational challenges that these larger companies had. So we spent a lot of time training people. We invited them into our networks and peers and connections through that building process of acquiring that company. Ran into a lot of folks. who were very interested, had the money, they had the time and energy and attention, and they really said, hey, how do we build one of these things? And so we started training them over, one-on-one over 12 months how to become an operator. And as they became successful in the operations, we have now raised up 4 of them that are working directly with us in multiple companies. They now help us control and operate as operators who take a percentage of the profit for their operations. They're partners in that way. They aren't actually employees. And then we have raised up a group. We have like 5 more on a list who want to work with us, who came up from our client base, who are currently running, operating in this space, and are like, hey, if you guys ever have any partnership projects, we also want to partner with you on those projects. So in that way, I've trained up people in my processes. I've trained them up to be successful. They don't have an employee mindset. They have a hunter-killer-go mindset. They have the entrepreneurial spirit. And so we now have a position by which we can start acquiring companies again, but do it in a very different way with a whole different purpose.
Okay. I want to talk a little bit about the meeting with Kevin Harrington, I think it was, and abundance thinking, and maybe you giving us an overview of Neil 1.0 and then Neil 2.0, like who were you before when it comes to thinking, mindset, view of the business, view of the opportunity, how large it could be, and who were you, like Neil 2.0, like after getting all
that? When did it change? When did it click? Neil 1.0 was a working guy who literally went to college and dropped out so I could find out what to do on the internet. Because I was in a business, a music degree, which I realized at that point in time wasn't going to take me anywhere. The internet came on, and so I dropped out of college to go figure out how to be on the internet, and I ended up in a startup company called Sprint PCS, which was launching mobile phones for the first time into the mobile space. And so I got to ride the Sprint PCS up from the 5,000th employee when I got on board, and I had 5 people underneath me, and we were overseeing all the knowledge management website and information for that company when it started up. To about 25,000 reps and 80,000 people by the time I left. So it was a huge startup period. Watching the mobile phones, got to see that whole company grow from the inside out, which was fascinating. And then Neil 1.0 didn't know what else to do just yet in business. So I had a side hustle while I was playing games on a server back when it was not YouTube, Twitch, etc. I built up a company called Killer Game Servers, and had about 10,000 people playing games and using a codec that I had developed to do real-time communication like this while they were playing mobile phones. That was before it was all embedded into the games. And so I had that little side hustle going on, and then IBM came over and said, hey, we want to pick you up. And I was like, okay, well, good paycheck. They're going to fly me around. This should be fun. I've never, worked for a company like that. So I got employed by IBM. So I said, okay, let's keep riding that for a while. I still thinking I eventually want to get out, do my own thing. My uncle, who was kind of like my mentor, and he was somebody I relied on. He was a business guy, unlike my father, who was more of a hardworking blue collar, 30 years at the same company, super awesome guy who was just a hardworking guy. Never really taught me about businesses, finance, and money, but my uncle did. And in that process, he kind of opened my mind to the realization that I should be doing something of my own. When he passed in 2005 from an accident, about 2 years later, that's when IBM and I separated. I kind of got to the end of the road. They had some changes in the company, and I said, well, let me just take early retirement. And so I left, and I fired the man in 2007. It took me about 2 years after he passed to kind of get to the place where I felt like, okay, I can't go any farther. I need to get out on my own. That was 18 years ago. And through a number of ups and downs, positive and negative, I got refined into the guy I'm today through fire. Through positives, through going bankruptcy once, through that process, which was terrible because I risked it too far, to having, very good, successful companies that made millions of dollars. And that kind of led me into the process by which I started to realize there was a lot more that I could do. It's just how far did I want to push it? As I had a family, started my first, had my first child with my wife in 2007, right after I left IBM, and then had 4 daughters. My purpose and value for the business has all changed. My goal was to stay around my family, and so we homeschooled my girls. And so I was an ever-evolving process to get from 1.0 to 2.0. And by the time I reached some of the relationships in the network that I needed to really kind of expand my reach, that's where I was actually ready to talk to somebody like Kevin, to actually, and everybody wants to jump in and be like, oh, I'd love to meet this person. And then what do you say? Right? You're not ready. You're not prepared. You don't have the same language. You don't have the same experience. You don't have the same, aptitude about finances or money or family. You just don't connect on what I call the 5 F's, right? And I didn't have the stability of these 5 F's. And once I got control of them, I was a very different person. And that different person in my walk was ready to meet different people who were willing to come alongside of me when we weren't peers. We were now more at a peer level. And with that, the conversations can be very different. And those 5 F's are faith, right? A faith in yourself, a faith in God, a faith in, something bigger than yourself. Personally, for me, it's God. And family. Do you have the family support you, a structure of family around you? Which then begets friends. The third one is friends because, friends are sometimes stronger than family. Friends are sometimes there when your family is not there, and sometimes they act like your family. It's a very strong connection with friends, and you need them. The finances aspect, right? Number 4, finances. You have to have finances to do any of these things. It really is true. You have to have money to make money. You can't do everything for free and just make it big, okay? You might get started that way, but you're going to need finances very quickly to get anywhere. And of course, you need to run your house, pay your bills. You can't run your business on gut feel. You need finances. And the last one's freedom. The foundation of all of those F's is freedom. Why do any of the other things? Why have any of the other things if you have no freedom? And the freedom can be of choice. It could be freedom of faith, freedom of your thought process, freedom to do what you do, freedom to control your schedule, freedom to be around who you want to be around and who you don't want to be around. And when you put all 5 of those together, you find that as a person who grows into that relationship, you resonate at a different frequency level with other individuals, and you figure that out in the first 30 seconds you talk to them. And when I met Kevin, we had a resonance. There was just I was ready, I was confident, I knew who I was, I knew where I was going, and that just made the other conversations that spread out over the course of 3 years into something that said, hey, let's do business together. And we developed that business out of the 2019. And from there, I've had many other of those relationships that have helped expand my businesses out farther now, including the connections I had with the guys from Patriot Growth Capital and the growth and structure of that business model that's now put me in front of guys who do tens of millions a year and billions a year in business and who they are as people. And that network is now my network, and that's who I am. And so now we get to connect at that level. But it really is a frequency of what I call the 5 F's.
Okay. Thanks for this great overview. So between 2019 and 2021, you raised over 100 million to build Voltage portfolios.
Correct.
But you pulled back in November 2021 when I saw the market was overvalued.
Yes.
Before doing all this, what did you see in 2021 that others didn't?
So we have both been, and my partner who started with me in 2012 is still with me today. He is more of my right-hand brain. Like, we make one combined brain from the marketing, the business, and the big picture thinking, the ideas, and pushing boundaries and jumping off cliffs without parachutes. That's me. He's more of the stable, conscientious. Where's my numbers? Where's my spreadsheet? Where's my finances? Where is my operations? He's that guy more tactically. And together we kind of saw a holistic picture of both opportunity and then opportunity costs when he came down to the numbers. After building the picture, the relationships, the connections, doing the meetings, raising the expectation and building up the expectation of what we were going to do and how many companies we were going to buy, where we were going to value them at, which ones we were going to target. He was running the numbers behind the scenes, making sure that we could do it operationally and control it all. With that, having been very good operators of companies to date, successfully through a number of major changes economically, and even most recently through the 2025 nonsense that, cost a lot of people money, and many businesses went out of business because of the issues, even up to right now where we're dealing with tariffs that we have to deal through as we have physical products moving. We are very strong at operations. We run very lean. We don't have a hard, high overhead. We learned to do a lot through trained resources and structured resources that we spent a lot of time developing into our processes. We, hired guns, contractors that work very closely. And since we do so much business, most of our business is dependent on them. And if you think about it like a manufacturer like Toyota, who has 200 suppliers, those 200 suppliers pretty much supply 100% of their efforts to Toyota. Right? If they're making dashboard parts, they make millions of dashboard parts for their largest client, Toyota. So if you look at the way I structured my operations, these individuals who are supporting graphics, AI, copywriting, and other components of our e-commerce company, they do so much business with us. They're almost exclusively a part of what we do, even though they're not employed by us. And because of that, we built a very lean, strong, mercenary force of highly trained and motivated people. And we had very good operational controls in place to support each business that was going to be acquired. When you look at the other companies, what they did was they went out and they kind of ended up accidentally or on purpose, I'm not sure which, missing the operational component required to run these companies. So they ended up with 125 to 150 job recs open at any one time, trying to fill all of those components. And what ended up happening was if they were trying to hire people out of companies or from companies to get that top level expertise, those people who were strong enough to do that were already doing it in their own companies. You see, they didn't want to be hired in to do it at that level. They could do it themselves. So when they found that problem, what they discovered was they couldn't operationally control the companies at the level required to keep them running. So they would acquire a company, and then eventually that company's, market cap and opportunity and market share would start going down. And so what ended up happening is they were just trying to acquire more companies to make up that difference and deploy the required capital that the equity companies were, requiring. When you reach certain levels of office and institutional capital, they require so much capital to be deployed so fast, and that's part of your contract. It's like, you need to deploy 25 million in the next year. That's what we're requiring. If you could do that, you meet the requirements. And to some people, that doesn't make a whole lot of sense, but that is their requirement by which they have to deploy the capital, and they have to put it to work. And you have to commit to doing that. And what ends up happening is, if you can't meet that, what these companies inadvertently did is they couldn't operate the control of the companies on one end. So what they could control was how much capital they were deploying on the other end. And behind the scenes was chaos. They didn't have enough people in the right seats who had the right expertise to run the companies. So they were putting warm bodies into seats and saying, here's your standard operating procedure. And that person had no idea what they were doing. And behind the scenes, it was just operational chaos. And that inadvertently caused these companies to be overvalued. And then when it got down to the basis of what are they actually operating at, that 30 to 40% about a year to 2 years after that bubble went, those companies all went down to literally going out of business, bankruptcy, selling off their assets, or being investigated for, investment frauds. And so we saw the writing on the wall. Operationally, they were not set to handle the capacity by which they were deploying the capital. We could see that as operators, and they must have seen it somewhere or something. They just were going too fast. They couldn't handle it, or they didn't want to handle it. That's sort of up for debate there.
So not too many people have this experience, what you just shared. You had 100 million committed. How do you make the decision to pull back when others might feel trapped by the capital?
Well, there were people, I'd say the majority of them were pretty happy that I pulled back, and explained, look, here's the situation. I would be mismanaging your funds if we took them now and deployed them, not because of operational controls or our ability to handle it, because you're buying an asset that is going to depreciate potentially in the next year by 30 to 40% below where it's going to be purchased. It is going to flip-flop. This is a bad thing for both of us. And there was only a few people, because we went to the home offices, there were only a couple people versus like hundreds of investors. We only had 3 or 4 involved. At least one of them was upset. The other ones were like, thank you for not doing this to us. Right. And those relationships were stable. The affect of the other one was mostly just, I thought you understood where we were going. I thought you did your due diligence. I thought you understood blah, blah, blah. I thought we were going to deploy this capital. Now you're telling me we're not. So that person was not happy, which, 3 out of 4 ain't bad. In the end, everyone would have been pissed off had we bought a bunch of companies that lost 30, 40% of their value, within 18 months after purchasing them. And only because the market suddenly deflated the value of those. We could have been perfect operators, and I would have expected us to operate within our capacity and do our best within reasonable effort to maintain the business stability and growth that we expected it to do. But there was a market segment of a crushing change coming that just the valuation of those companies would have floored out because the whole market floored out, and there was nothing we could do about that.
What about the timing if you're thinking back? Let's say if this would have happened in 2015, how would things be different?
Well, there's a thing called mass adoption in any market segment. You're familiar with this. There's a bell curve of mass adoption. There's early adopters. There's middle market adopters that start to take on a segment. Then there's mass adoption that occurs, right? In any early adopter stage, tech startup, otherwise starting up a business, there's always that growth period where it's the highest risk period. It's the most costly aspect of the business. Any money taken during that period is the most costly money that you will ever spend in the business. As its value comes up. In a market like e-commerce, it was on a pivotal upturn. Okay. So what we had not seen yet was mass adoption through internet and e-commerce, because retail sales, right? Other sales not online were still much greater than e-commerce sales, right? Everybody sort of understood it. Many people thought it was a novelty, and they didn't really see it as a normal part of their daily life. It was not in complete mass adoption yet. So what ended up happening was people in the money sort of forced a mass adoption event through movement of funds that were moving out of the market segment and changing somewhere around 2017. I'm not sure exactly what market conditions led to this storm exactly, but the storm in essence became, let's deploy as much capital into acquiring e-commerce companies as we can. It almost, if you look at the timing of it, and I'm going to put my tinfoil hat on for just a second, it was leading 26, 17, 18, and 19 right up to 2020. So what ended up happening in 2019, 20, and 21, we all sort of know, we were paying attention. But in that perfect storm of acquisition, what ended up occurring was no one could go buy anywhere else but online during 20 and 21 and 22. It was a perfect storm of mass adoption, and that's exactly what happened. In the first quarter of December 2020, we saw 10 years of growth in 3 months. We saw a hyper growth. We saw many people who had never adopted online purchasing suddenly move into mass adoption of online purchasing. We saw for the first time in the internet, mobile purchases overtook desktop purchases. Okay? Meaning more people were buying on their mobile phones than ever before. People like my parents and a whole generation that was resistant to purchasing online suddenly were forced to purchase online. Now, they did it out of need and because they couldn't move, but as you go through 21, 22, and 23, they started to find out, well, that's a pretty good convenience. I actually like doing this. It's a little bit easier. So then we pushed into mass adoption. All right. So take that for whatever you want, but it would really feel like the market somehow kind of knew what was happening as all this capital was being deployed into what became a very hyper growth situation in the years 2020 to 2023. It has since kind of tapered off in 2024, but now we see mass markets moving in this. What we see is a wealth transfer occurring, that more people are now buying in a faster by faster rate online every year than a retail. And in about 10 to 20 years, at the current pace, it will flip-flop. It will change from retail being mass consumption of products and services to online now being the mass consumption. It's going to flip. So regardless of whether you be a part of the business or not, whether you're a consumer or whether you're a producer of products and goods that support that, it is going to change. I prefer to be on the producer side. So as we look at this growth and change, we now see mass adoption in the e-commerce world going past 20, 21, 22, 23. With that, what's happening now is these companies that came through that period and were strong make great acquisition candidates. Why? Because they were able to overcome the cost, the change, the hyper growth. They gained more market share. They gained more stability. The companies that were pre-2020 that then went through 2020 and up to now and today, 2025, are much stronger in their base. As we look to acquire companies that are 10 to 50 million in size, they went through that. They were hardened by it. They've actually gained a lot more market share, been very strong in their operations, very strong in their product and brand. And now is actually a better time to acquire than it was before 2021.
Question: how did that experience shape your view on capital allocation in the crowded markets?
Yeah. Well, one of the things is, of course, he who has the gold makes the golden decisions, right? So if you're the one with the capital today, we're able to do more creative financing than ever before. And one of the things we really look for is an operator who's willing to stay on with the business and look at a creative financing option over 5 or 7 years as we move that business into a second acquisition position, right? So as we know that, then every investor who's getting involved in, say, a PGC business is going to know that their capital has a potential for return rate, but not in the first 12 months, not even in the first 24 on some of these, but their equity stake in it will then mature years 3, 4, and 5 as we move to an exit, and the majority of their opportunity is at the next exit. So as we have now home offices and higher capital and institutional capital watching us, when we go to get these businesses raised up, it'll be much easier for us to sell them once they reach that particular market cap, because those other offices and institutional capitals can deploy that capital really fast. So we see capital deployment being more in the growth of the business and less in the acquisition. So we're not desperate to acquire the business. We want to actually make sure that we do a great creative financing deal with the owner and even maybe keep them on even at 15% or 20% and put them in a specific role they feel good about to keep them involved with this. But also in a win-win scenario, that brings the opportunity for us to bring a lot more capital deployment to the business, by which we can then open up additional sales channels, greater marketing, greater connectivity through multiple tactics of marketing that the owner hasn't been able to do. And we can deploy that faster and larger knowing that it's being moved to the upside potential, not just the current operational day-to-day cost and profitability of the business. While it will grow and is expected to grow, what we're really shooting for is that much larger exit. That makes sense?
Yes. When it comes to the structure, you mentioned leaving the owner with 10 to 15%. Is it always the case to always buy a majority?
Yeah, it's always the case to buy the majority. We are capable of operating the company, so we don't need the owner. But if the owner has done really well, and in a specific area of the business, we see opportunity for them to stay involved because they're very strong at it, and we see other opportunities where we can bring our strengths to the table, it makes sense to leave the operator in place. Plus, they have a lot of intellectual capital setting in their head that isn't always defined during a transition process. Well, you can say, well, Neil, give 12 months. That should be plenty of time to transition. It's not always the case. It may take a few years for the intellectual capital, the what ifs, the gotchas, the whatevers could have been fixed to be addressed in a business of that size over a few years, not just a few months. And so by bringing the owner along, it's sort of an insurance policy to make sure that we don't miss any skeletons in the closet. We don't miss any of the minutia until we get into full operational control and understanding as a management team, how to deal with any changes in that business. Having that tactical operator around means we have that intellectual capital setting there until it can be transitioned into other people or transitioned into systems. And we will look to see the businesses that have that opportunity for those reasons. Now, if it's a company where we're like, the guy or gal absolutely wants an exit, that doesn't stop us from acquiring the company because we can't acquire it. What we'll do is we'll just set their time frame by which they stay involved in the business out a little bit farther to give us that run rate. And those are always negotiable points when you're getting through the deal-making process, because really it just gets down to most of the time, not just the money. Everybody who's selling their company is not just all about selling the money. They're about selling the emotional connectivity to the brand and ensuring that whoever takes it on can give it new life, and they can say, hey, look, I started that brand, now look where it's at. Right? They want that feeling that you are taking responsibility and ownership of the brand and the sweat and blood and tears and late nights and issues and, risks that they put into the business. And you don't understand, man. At one point I put all my payroll on a credit card. I'm like, dude, I get it. That was a tough time, right? And it's like, yeah, that's why this whole thing means so much to me. It's like, no, I completely get it. And we want to see this thing grow. There's a lot of emotions tied into that, not just the finances.
Who is the typical seller?
Who is a typical seller? We, in our world, from the e-commerce, it is somebody who's typically has a multi-channel type of business model. A lot of times they're individuals, sometimes they're partners, sometimes they're family people whose wives or husbands have been involved in growing it up. They are typically not in a large operational capacity. Sometimes they are, depending upon the size, like they've got 20,000 square foot of warehouse and 7 people in a warehouse shipping products and dealing with operations. And then you find, usually the management teams are only 2, 3, 4 people deep. So they're not extremely employee burdened types of businesses because of the e-commerce world. Unlike other types of businesses that might do $5 million a year with 50 employees, you can do $5 million a year with 1 person and a couple of VAs. You can do $10 million with, 3 or 4 operational staff for e-commerce companies. With the systems of automations and control, the economies of scale for these businesses do not require, tens and hundreds of employees to run them. So what we see is typically the business owners have, understood that concept and used the systems of automation and virility and internet marketing and third-party logistics companies and platforms like Amazon FBA to move their products into the market at greater scale without requiring the higher economy of scale of infrastructure or people capital, which also goes with payroll and healthcare and all the other nonsense that comes along with it. It's super expensive. And they have been very lean and strong in what they do. They are almost always U.S. based. Most of the time, we don't like to buy companies that have large infrastructure. So big warehouses or a number of people in the operational controls. Or we see that if that's there, we will transition it to some component of more streamlined operations and using our partners in the logistics and warehouses space to remove some of that overhead and increase the economies of scale. Maybe the operator didn't understand that. Maybe they didn't want to risk it. Maybe they didn't have the capital to do it. We look at those and say, is that still something that fits within our buy box? They must have more than $1.5 million in net EBITDA bottom line. Typically, we want to see 3 to 5 million or more in the business. The longevity has to be more like 5, 7 years old. minimum established brand in each channel they're owning has to be at least 10% or greater, or we have to see an upside potential. They can't have every egg in one basket. If they're a pure DTC Shopify play with 99% on Shopify, we're going to say, okay, how fast and what is the brand and how fast can we move it into, say, Amazon or TikTok or another sales channel to create a tripod of stability along with the halo effect that they've missed to stabilize that business. We'll look on the other side, and if they're Amazon FBA only, we're going to say, hey, why haven't you done a Shopify? Why haven't you done your own website or some other mechanism of sales? Why aren't you in retail? Why have you never done these things? And a lot of times you just find the owners got their arms stretched out so far they can't go any farther. They've gone as far as they can go, and we're looking at it and going, okay, we can get the next step going. We can move this into a DTC channel. We can really blow this up. We could double the business putting on a direct-to-consumer channel of marketing and online and capture the halo effect that's occurring that they are just not grabbing currently. And so we just see that in the business, and it's kind of what we call our buy box, is what you're asking about.
Which is like an absolute perfect target company for you. Something, if you can acquire that, you're so excited you can't wait to get out of the bed. What I'm trying to understand is...
I actually have one of those. Well, we have 3 in line right now. So we've gone through about 400 companies in 18 months just to give some people some scope. There's a lot of due diligence that's required to do this. This is not an overnight process. This is not like in 3 months we have a $10 million company. This is the old adage, 18 months, 18 years to an overnight success, right? There's a lot of time and diligence and conversation that has to happen. So I actually have one of those that we missed the boat on one other one, actually 2 of them we thought were really close and we were ready to go to a letter of intent. And in one instance, the owner backed out and was like, no, I think I want to do this on my own. And in the other instance, they kind of lollygagged around a little bit and they're sort of ghosting us, but still communicating. And they really haven't pushed to the end. And so as it turns out, the third company that we were really serious about was actually my preferred company in the end. They have an omni-channel setting, Amazon. They have a website. They have a large retail presence that's being pushed really well through multiple retail channels to kind of create that halo effect, which is good. I want to grab that while I can before it shifts. As I mentioned earlier, it's going to shift eventually. But I still want to get into retail while it's still the majority of sales. And so they have a very good stability, a good halo effect, a good multi-channel effect, a good upside potential to the kind of products they have. They're not only just trending, but the products they're selling are evergreen. They're run very lean, and well. They have a small warehouse for intermodal transfer of products to marketplaces. And the owner has just done a really great job with the branding and the overall presence. And I have children, and this aligns with the children niche a bit because of the kind of products it is. It's not specifically for children, but it is in that, it's in the arts and crafts and supply space. And I have girls that love to draw, and a couple of them are pretty good at it. And so there's just a lot of connectivity to this kind of brand. And, we can literally go down and see it on the shelves at retail stores, which is cool too. And there's just a number of things that the owner has done extremely well with. And it really creates a very solid foundation to double growth, plus the upside potential. So what are we looking at? When you buy on trailing 12 months, you do not buy on futures. But I look at the futures as where I can drive this ship forward. Where are we going to operationally go? How are we going to deploy capital? Where's the upside? So there's 3 other competitors to look at and say, okay, what is the market share? This one in particular niches into about a $750 million a year market share. When I look at them, they're currently the 4th in position in market share. These other 3 make up the rest of the market share. Well, that just screams huge opportunity, right? That is like upside potential up the yin yang. So our forecasts are between 50 to 75 million in the next 10 years or less for that business, where it's currently sitting at around 10.5 million in sales and growing. So we see huge upside potential for market share that is there to get. It is there to take away from the competition. We believe this brand is really positioned by its brand, its market, its reviews, its engine, the halo effect by which it's created. It's easier to move it in the next 2 to 3 years into position 3, and maybe in the next 5 years into position 2. And that puts that market share upside potential as a great win for this company.
So you mentioned, we talked a little bit about before, buy and build versus buy and hold.
Yes.
How has this changed over time when it comes to your mindset and when it comes to building businesses?
Yeah. Well, I actually have all the operators in my capacity now that I need, so I'm actually turning down the consulting side of our business, and we're slowing down on taking on any clients that might want to build with us as a one-on-one, people who might be, typically in their 40s to 60s, and they want to build, and they're looking to build up an operations. They want to, get out of something they're doing now, and we help train them up as operators to build their own companies, and that's one of the things we've done to build our, operator base. So we're kind of pulling back on that a little bit because we've actually innovated a really cool software in our niche, in our market space, that is, I believe, speedboat to the Titanics that are currently out there. And so we are finalizing development there with the use of AI systems. Amazon and other online marketplaces out there, including Facebook and other viral, TikTok and other viral types of things. I've used a lot of AI lately. We know, right? We see it. We understand it. It's a part of all things, including forecasting and planning and operational controls and managing PPC now. It's just all within our business. And one of the things we use it for is data analytics and intelligence. And as we had built that into our system, what we call our green light process, by defining a product data set that we would consider for market as we're building a company. And in that process, with some new data intelligence that Amazon was willing to give us and AI agents that we use to go out and pull this data and intelligence together, thanks to a session by my 15-year-old who was helping us massage some data and doing some legwork, on the analytics side, she pulled a thread. And when she pulled the thread, we didn't have an answer. And when we went to development, we said, how do we actually go get this data? And we just looked at a different way of looking at that data because Amazon's AI engines are now becoming a prominent forefront of how that engine works. And with that, we suddenly realized there was a different way to look at the data and grab the data to understand exactly the customer needs on Amazon. So we pulled that together, and lo and behold, there was the data. The exact data that tells us the 100+ thousand actual customer needs, meeting all of Amazon's demand for its $638 billion a year. It's basically like having Jeff Bezos go and say, oh, great, here, Neil, this product is a super customer need, and it's setting in this location. And if you just launched this product, it has 50,000 units of opportunity every year. It's literally like him handing us the keys to the engine and saying, here, just sell this product. And we have that now. And we're putting it into a system. In a SaaS software, we're going to launch it. It's called Cayman Data. There's a big old acronym for that, but basically, Customer Amazon Intelligence Engine and Analytics Navigator, Cayman Data. And it is going to launch in this summer, and it's literally going to show people the exact data that tells you the exact products, which product, where it lives in Amazon, how many units it's moving, and how profitable it can be to meet the exact demand that is already flowing through Amazon. And so we're moving and shifting our systems towards that. So we're going to be more of a service provider. All of the training that we have for the last 12 years will be incorporated into that. There'll be a SaaS business fee for that will be paid monthly to be a part of that subscription and a part of that training and that community to build up and become operators. We'll be launching that this year, and that's one of the things we're transitioning towards as we build up that customer base. And then being focused more on our product partnerships and brands that we already run. And of course, working on the acquisitions. So as we're transitioning this year for opportunities, that's kind of where we're headed. That's how I see it now. That's where we've been transitioning. And so it's time to put that software in the market and run it up to an acquisition.
How do you manage it all when it comes to focus, now launching a SaaS software, having a fund? How do you do it all?
Very smart use of capitalization. Literally. You have, like my partner, for example, running operational controls, raising up some of these individuals from the other locations and training them to become great operators and discovering, well, you have other talents that you can use. And what if you did some of these things, who have now stepped up, and because they're successful from Voltage's brand, they're like, hey, I'll do whatever else. Let's do some other things. I'd love to partner. What else can I do? And because they're good and trained and motivated, I don't have the employee mindset to deal with. I don't have the payroll for an employee mindset, and I don't have the healthcare problems. What I have is people who are anxious to earn and learn and do more things and grow bigger. And because of that, I don't have to micromanage their activities. I don't have to micromanage their mindset. I don't have to micromanage their production. They are self-motivated, driven. We have short meetings because of that. We have objectives and key results that everybody understands what their role is in those particular areas. And so I don't have to micromanage. It's very important that if anybody feels burdened by the amount of activities they have, it's typically because they feel like they can't get somebody to do what they want to do and then take initiative and do it and actually see a positive result. And when I discovered that a long time ago, I discovered it because I was dealing with employees. And employees have no vested interest in the growth of the company other than maybe profit sharing at some point, if you have that, or a paycheck, right? They're motivated by the next person in line. They're not motivated by the entire company. And that's why people leave companies, because they leave the managers. They don't leave the company. And with this, we have a very flat structure where there's no management tiers. And in essence, everybody is a part of an organized team with specific tasks that they go like mercenaries and attack. I don't want to micromanage every aspect of that. I want them to be good at it. And they are. So I only select those who are actually good at it. And so that means that I don't spend an entire amount of time every week or every day micromanaging every particular thing that people aren't supposed to be doing or supposed to be doing. They're actually just out there doing it. They're self-incentivized. And that creates a whole ecosystem by which we kind of move together, almost like an ant colony. Everybody knows their particular role and they like what they do and they go out and do it. And that just means that I don't spend an exorbitant amount of time in, business meetings that are just geared towards what's our productivity, what's our sales numbers, what's our goals for this. We have operators that come in and they're operating the companies and they're just like, here's where I'm at. Here's where the PPC is. Here's where I'm going. Here's where I'm driving our upside towards. And I'm like, great. Do you need anything from me? Nope. I got it. Okay. We'll talk again soon. If you need anything, just text me. And it makes it much easier to allow all these different things. So when I need to step into the role of doing something like, hey, we're launching the SaaS software, my partner in that, Aaron, who runs a very large agency, is somebody who I've known for years, came to me about 2 months ago and said, hey, I don't need to do any of this anymore. I don't need the money. I'm only looking to do good things with people I want to do good things with. What are you doing? And we went through a process of talking about what's going on. And as soon as I showed him what we were doing with the software, he's like, dude, we have to get this in the market. And I said, well, I just, that's not my primary focus. He's like, well, what if I make it my primary focus and I bring my entire team and agency to the table and we go after it? I said, absolutely. So that conversation led to a partnership where he is now the lead role, the CMO, over moving the SaaS to market. And he's bringing his entire agency to the table to do it. But he doesn't need me to micromanage that. He's got that well in control. We have our meeting and vision about where we want to go and what we see with the product. My partner's involved in where the product development lifecycle is at the tactical level because he knows it very well as an operator. And together we're going to launch this software with a goal of getting to our first, 1,000 and 5,000 and 10,000 users. And we have a roadmap to do that. We'll have the capitalization to deploy it. And I have a whole team of people now behind me that are going to go out and do every tactical thing necessary to make that successful. And they don't need me to micromanage them.
Do you consider yourself being an operator or investor?
I have moved more into the management investor role. As the CEO of the company, it's something that I have had to work myself up to as we've gone through this process with, Aaron being more CMO level, Reed being more COO level at the operations control finance level. They don't need me to, get in their business about that. They know exactly what to do and I trust them implicitly. So now I have moved more into the relationships and building. I'm at the top level of the acquisition process for the companies we're evaluating. If they're good, if we see the upside potential, if I understand the vision and the numbers as I go through and look at that tactically, then I turn it to the team and say, hey, this is something you guys should dig into the weeds on and figure out if this is something we should really do. At that point, they get into the weeds, go through the numbers, do the due diligence, and then come back with pro formas and stuff and say, hey, this is something we should take a look at. With that, I have, team members that we trust implicitly to go through that. They're operators. The guy who helps us do that is somebody who has sold multiple companies. He is also an operator of 4 other brands. He knows exactly what we should be looking for at the business, the numbers, and the finances. And so he acts as that individual who goes out and makes sure that that there's the analysis is done and the analysis is done and comes back and says, hey, this is definitely something we need to dig farther into. So everybody knows exactly what they're supposed to be doing because they're very good at it.
You've been doing that for such a long time. What's maybe one lesson from being deep in the trenches as an operator that gives you an edge today? Something that comes up.
Well, that is a great question. There isn't just one thing. Right now, a lot of operators are feeling that the tariffs are a completely destroying effect to our business. And I don't actually see that. I see them as a method by which and a tool by which change is being forced. Change that I see and I saw coming. So as we were looking at businesses in China and other things and where our supply chain is, we made a lot of movement of products out of China. We have a few, and so do our clients, that still are being manufactured in China, and so we're working through that. But we have also done quite a bit of sourcing outside into other locations prior to even getting to the tariffs, just kind of seeing the writing on the wall. If you get out and you get into enough details and you hear the cadence, you hear the geopolitical, you hear the news, you hear just operators in different groups and forums, and you talk to friends of yours, there was definitely a reckoning coming with this new administration, and it wasn't very difficult to see that things were going to change. Nobody knew exactly how, but as we've gone farther into this new administration by April, it's getting pretty obvious that things are changing. And what things are changing are supply chain, accessibility to products, and of course the cost of that. And while the cost of the tariffs is adding on additional funds, it's a little surprising in some ways the way this is being done, even though I can't understand it all just yet. And I'm sure in about 6 months, it'll make a lot more sense as this keeps going forward. But the costs of some of these products, they're nowhere near what we paid in 2020 or 2021. So what I'm hearing, though, is that the number of the companies that started or did something in the last 2-3 years, maybe even 4 years prior to that really big change we saw in the market, this is their big change. They would have been screaming during the COVID years if they had been a part of that. Now that this change is here, they're screaming about the tariffs going up. And I have a feeling it's going to go up a few more points before something gets figured out. But make no mistake, at $4,800, a full 40-foot container that could jump to $9,800, that could jump to $12,000. Remember, we were paying $15,000 to $25,000 per container in 2020. So we haven't hit that threshold of pain. We've already walked through that. Others have not. So we're trying to help them mitigate, these changes and these costs. It just gets down to smart operations. You can't run at profit margins on your units or your business that are so small that kind of change completely implodes your business. If that is the case, you have always been in a position to be victimized by the market. It was just a matter of time until some geoeconomic manufacturing act of God or some, two countries duking it out caused your supply chain to fail. And that is a problem that needs to be addressed in the business management. Many don't understand the fundamentals of business, and they're struggling with it right now, and a lot of people online are, and I feel terrible for them because they're going to end up being priced out of the market. This is one of the things in our business where we say friends don't let friends sell $20 products on Amazon. We sell a minimum of $50 retail and up. Most of our product base is between $100 and $500 per retail price point. Why? Because we learned quite a while ago, there's a lot more profit, and we can sell those products just as easily as we can sell the $20 products. So at the end, it's the same level of effort. It might take a little bit different of capital deployment, but the upside potential is those products will stay in demand for the people that have the money, and the margin is there to overcome these larger challenges. That is just elevating the products and brands into a place where I'm not at a 5% razor thin margin, where a 120% tariff kills your business. And there are a lot of businesses on Amazon that are in Shopify and, with AliExpress and other drop shipping things closing down the de minimis loophole, which is going to impact all of those companies. They were operating at razor thin margins at the end of the day between marketing and costs. And yeah, it's a terrible place to be in business.
What is something you're struggling with today?
Something I'm struggling with today. Allergies, because it's April. So my head's swimming and my mouth is dry and my eyes are watering. And that's what I'm struggling with personally right now is allergies. What am I struggling with in business? Is that your question? More specific?
Yes.
Yeah, I know. That was
a lot of things going on.
Yeah.
Things going on.
What am I struggling with in business right now? That is a great question. It should be relatively obvious to name my pain points. They aren't terrible, honestly. What am I struggling with in business? I'd like Amazon to play better on our marketplaces, products there. Amazon, we're struggling with a bit of realization. This is one thing that has been exposed in the tariff process is how many Amazon based companies that have some connection to China are being allowed to do just unchecked things in the marketplace outside the terms of service, even outside of legalities, that are kind of being exposed in this process. Like the cover's been pulled back. They've been hiding for a while. Maybe Amazon's been, protecting them. So I'm really disappointed to find out how many more companies than I realized on Amazon are violating their terms of service, and Amazon is allowing it. They are being protected by Amazon and not being stopped. And in other ways, they're cheating the system with fake invoices, fake manifests, fake, customs, receipts, and all kinds of things they're doing to manipulate the system, whereby the legalities of the United States would come down on my head like a ton of bricks, and I'd be forced out of the market. And they're being allowed to do it. That's extremely eye-opening and quite frustrating to see that there's a whole segment of our middle market opportunity that, individuals and aspiring entrepreneurs and those who are building up their companies, 500 million, 5 million a year, are missing huge opportunities and potential simply because another country is stealing it from them and the corporations have allowed them to do it. That's frustrating. That's probably one of the worst things I'm seeing out of the tariffs right now.
Where do you want all of this to be in 2030? Your fund, your SaaS?
2030. So 5 years from now. What's my 5-year goal? I'd like all 20 of our brands to be doing more than $1 million a year in profit, or greater, minimum, in the next 5 years. That's a great minimized goal, I think, for 3 to 5 years. I would like all of our acquisitions to be strong and have at least 5 to 10 of those under our belt in the next 5 years that are strong acquisitions, putting us somewhere around 100 million in total managed business. That's what I'd like to see in about 5 years. And either one of those are in a position to have, law of averages. We acquire 5 or 10 of those companies. 2 or 3 of them are just going to explode. That just happens. That's just a law of averages that you do a great job. 2 or 3 are going to outpace the other ones. And I'm hoping that 2 or 3 of those really become some really great horses in the race. Not that the other ones won't fail. They just won't seem to hit the market stride. It's time in market. It's particular product. It's the business. It's, 2 years from now, another competitor falls down and we stand up and woo, that business just takes off. The more of those you have running, the more opportunity there is to see that. And so I'd like to see, an average across all of our brands, but I'd like to see out of the 20 or so, 2 or 3 of them just explode in the next 5 years would be great. And it's just time in market and patience.
Okay. As I'm an avid reader, what is your favorite book?
I constantly reference Good to Great by Jim Collins. There is just so many fundamentals of learning about what makes a great business. And then how now, if you look past the book, even though there's the 80% of it is 100% applicable to today, the 20% that changed were what happened to the companies that were great. And how do you see them in the market? So as you read the book and then you look out and find out what happened to Walgreens, you're like, oh, a great company that completely lost control. What happened to them? What made them a great company and why'd they fall? So that's just a great book now to see past when it originally came out, and learning the process of who goes on the bus and where they get on the bus and who stays and who goes, how you become a hedgehog. We've become a hedgehog in business. We've got into a vertical segment of e-com and it's just hedgehog into all the revenues and brands and softwares that just align in this space that we're now hedgehogged into. Just great concepts of marketing and what makes a great company. And then to see the effect of it. Why did Walgreens go bankrupt? Because they were considered a great company. It's a great case study on both sides of the fence.
And last one, again, you've seen a lot. What is the best investment advice you've ever received?
The best investment advice I've ever received. Invest without expectation.
Okay, Neil. Thanks a lot for doing this. I really enjoyed this. You have lots of things going on. I tried to come back with some ideas,
been great. That's
some projects. Thanks a lot for doing this. What is awesome that if we do it again in 12 months from now, I can be sure that there's so many things which have changed, improved, some brands which have stopped, as you said.
Yep.
So very, very happy that you found time and let's do it again in the future.
Oh, great questions. I appreciate it. Thank you for having me on, for being a wonderful host.